If we look at my 6 biggest positions in the public account, there's one stock that is causing problems, okay, and its name is PayPal. Everything else is going just great except for PayPal. Now, PayPal is my newest position in the portfolio, so do keep that in mind. Like, sometimes it takes a while for these babies to get rolling, but nonetheless, it's a bunch of shining stars and PayPal. And so, first place I want to start with this, right, is I call this stock the best risk reward in the stock market in my personal opinion right now, right? And when I say the best risk reward, I'm really thinking about the next 36 months with the stock, and I'm thinking about the chances I 2x or more of my money, and I'm thinking about the chances I lose 50% plus of my money, right? And if we're talking about the stock goes to $30 a share, that'd be a 50% downside from here where we're at right now, right? Which would be considerable downside. Now, if you know my opinion in regards to PayPal, I call this the best risk reward since what stock? It's the best risk reward I've seen in the stock market in terms of like very low probability of losing 50% plus and a very high probability of at least 2x in your money since this stock, Meta, right? Meta last year was a stock that got absolutely obliterated, got sold off way harder than, in my opinion, it should have. I took advantage. I bought shares like crazy, and it's been up and up pretty much ever since, and it's been a grand old fun time, right? And so in regards to Meta, like this was a stock that just got pounded. I mean, for a long time. This stock topped in like August of 21. And ever since that time, it was down and down and down. It seemed like Meta was never going to bottom. And I remember buying Meta stock, and there was a lot of people saying, this stock's going to, $50 a share, $40 a share. It was all, it's going bankrupt. It's going to zero. Like everybody just throws out the most ridiculous stuff when, the stock's going down. Same thing when a stock's going parabolic up, but like everybody just starts throwing out any price target, right? And so first off here, it's like the Usher song. You remind me of a stock that I was once buying, okay? And that's Meta. And so what reminds me so much of PayPal that I see in Meta, and then we'll talk about is a stock headed to 30, okay? So the first thing is, if we think about Meta and we think about PayPal, I was convinced both companies are growth companies, right? Not like insane blow the top off growth companies like 30, 40% type growth companies, but both companies are growth companies, right? And in regards to PayPal, there's no doubt like PayPal's revenue should be up several $billion this year. It should be up several $1 billion again next year. We should see nice earnings per share growth for the stock, right? So this is a growth company in terms of top line and bottom line, right? If we look at its latest quarter, the revenues were up about 7%-ish year over year basis, right? They beat revenues by $14 million versus what Wall Street was expecting. Their GAAP EPS came in with a 10-cent beat. That's very nice. So in terms of PayPal's latest quarterly numbers, it shows that, yes, this is still a growth company, right? Second thing going on here that reminds me very similar of Meta is Meta got down to ridiculous forward P's that I was like, really? Like Meta's trading down here right now? And that's exactly what we're seeing with PayPal stock now at this point in time. When you go to a P this low and you're a growing company, that's the big thing. When you're a growing company, it provides a lot of protection for your stock price from another big downward move. If PayPal was trading at a forward P of 30 today, or let's say a forward P of 40, it's a very different dynamic. You're setting yourself up for a lot more risk because you can go down to these sorts of kind of like joke forward Ps, in my opinion, right? This is what we saw with Meta last year. Meta went down to like it was like a 10 PE or so on Meta, right? A 10 forward P, something like that, 10, 11 at the lows. And it's very similar to what we see going on with PayPal right now, which is just, in my opinion, ridiculous considering the growth that PayPal has and considering the industry this company is in. Like, that's insane, okay? So that's the second reason this reminds me a lot of Meta is just such a stripped down low valuation. The third reason is the balance sheet, okay? Now, Meta has arguably a top 5 balance sheet in the entire world. PayPal's not that good, but it's a dang good balance sheet at PayPal. Really, really impressive balance sheet. Current ratio on this one's about 1.3, which is basically current assets versus current liabilities. Anything above 1.2 is good. If you go 1.5, that's, above 1.5, that's really, truly great. But very good balance sheet in regards to PayPal. So it reminds me, there's no like, oh man, if things got hard, like could PayPal make it? Just like there was none of that situation with Meta either. Those are companies that doesn't matter the economic turmoil, recessions, no recessions, anything like that. These companies make it through. They make it, and they come out actually stronger than they went in. Okay. Fourth reason is growth levers all over the place for PayPal, right? I mean, absolute growth levers everywhere when it comes to PayPal. This is one of those stocks that I look at and I'm just like, oh my gosh, with 400 million plus users, with all the innovation they're working on right now, there's no doubt in my mind that this company doesn't have, just growth everywhere in terms of what they can do on the revenue side item, what they can do profitability. The one thing that's a little different with PayPal is I don't think they could pull nearly as much cost out of the business as, let's say, Meta did. Meta was a pretty exceptional stock in terms of just like they had hired way too many employees and they could cut some of those employees. PayPal doesn't have it to quite that extent, but they can bring out costs in this business. And if the new CEO wants to take some cost out, he can take some cost out. I'm just looking and there's so many ways. When you own PayPal, Venmo, and Braintree, and you got 400 million plus people that use, these different platforms, like I'm telling you, there's a lot of growth levers to pull for this company for all, 5-10 years to go in the future, right? Warren Buffett just made some absolutely unbelievable moves in regards to his portfolio. First place I want to start here is they're buying their own shares back, a lot of their own shares, okay? In Q2 2023, Berkshire Hathaway repurchased nearly 4 million Class B equivalent shares for a total outlay of about $1.3 billion. The pace of repurchases came down substantially from the $4.4 billion figure last quarter. Now, that's telling in itself. That basically shows that Buffett likely doesn't like the price he's paying for Berkshire Hathaway nearly as much this past quarter as he did the previous quarter, right? If you're going to slow down your buyback that substantially, that's not a small slowdown. That means you're looking at the stock and you're saying we're priced a little bit richer now. It's not quite as good of a deal, right? The average price paid was $333 of book value as of Q2 2023, was $252 per share, right? So that was the average price paid, but the book value was that, right? So the repurchase happened at 132% of book value in July, so which might seem like they're buying at expensive prices, right? In July 2018, Berkshire had announced a plan to make the repurchase criteria more flexible instead of the 120% of book value criteria. Buffett and Munger had agreed that Berkshire was trading below intrinsic value, that Class B shares currently trade at $359. Okay, now, what do I think about Berkshire buying their own shares back? I think it's an okay buy. I don't think they're necessarily buying at a super underpriced valuation. I don't think they're buying at a super overvalued valuation, and certainly where the stock was trading last quarter. I think it's an okay buy. I have no problems with that, to be quite honest. If Berkshire explodes higher over this next 6 months, I think they should cut that share repurchase down considerably more, and maybe even to zero if it really climbs substantially. But I think for now, I think some of those share repurchases are just fine, okay? Now, what about some stocks they sold completely out of? So first one up here, McKesson, which is more of a healthcare-related name, they basically got completely out of this stock. Now, I don't, if you know me, I don't really talk much or cover the healthcare-related stocks, right? But there is something very interesting that I see here with this McKesson stock, okay? Let me show you this. So this stock trades at what looks like a pretty cheap forward P for something healthcare related, 16, 14. That's not very high at all. So seeing a move like that, I don't know if that's really Buffett selling that stock, because this almost seems more like a Buffett stock you'd want to be in for the long term, healthcare related. Healthcare is needs based, right? Seems perfect for Buffett. It's not really going to go through the crazy ups and downs. A fairly low forward PE, right? That seems like a perfect Buffett stock. So I don't know what's going on there. Very strange to see that one kind of sold out of. It seems like a perfect Buffett stock, to be quite frank. Maybe that's a Todd and Ted move. Now, this definitely, like 98% probability, is Warren Buffett doing this, okay? Stake decreases. So they sold some Chevron shares. Chevron is a large top 5.56% of the portfolio. That's a huge position. Purchased in Q3 of 2020 at prices of $72.91. Q1 2021 saw a 50% selling at prices between $85 and $112. While in Q3 2021, there was a 25% stake increase between the price of $94 and $106. I mean, I don't know. I think it's kind of weird, like some of the selling and then buying and selling and buying and those sorts of things. But at the end of the day, this is such a massive position. This has to be Buffett. It's just strange about kind of some of the moves there. That was followed by another 1/3 increase next quarter at prices between $102 and $119. Q1 2022 saw a whopping 315% stake increase at prices between $119 and $171. The last quarter saw a 20% reduction at prices between $152 and $188. That was followed by 7% trimming this quarter. The stock currently trades at 164. Okay. Now, Buffett's not usually known as a trader, right? He's usually looked at as a long-term investor and somebody that buys stocks for the next 10, 20 life. Okay. But something I will tell you I've noticed with Buffett in regards to energy stocks specifically, I have seen him trade these stocks before in terms of decreasing, increasing position, kind of trading around a little bit, even getting out of complete positions. This goes all the way back to when I was very early in the stock market. I remember finding a video on YouTube about Warren Buffett selling out of a company named PetroChina, which was kind of a nationalized big oil company and gas company in China. And they made a lot of money on that position, let's just call it that. And he was just like, I'm taking my profits and I'm running out of this one. And so do keep that in mind. It does seem like if there is anything Buffett feels a little more comfortable timing in and out of a little bit more, it seems like oil and gas stocks. Now, the interesting thing was Chevron, right? And you guys know, certainly, I'm not the biggest oil and gas. I don't even own any oil and gas stocks, right? It's not my whole cup of tea. But it's interesting because Chevron obviously trades at very low forward Ps. So, I don't know. Like I said, maybe Buffett wants to be a little bit more of an in and out trader when it comes to sometimes these oil and gas stocks, okay? Now, next stock, he sold out of completely. I'm not surprised by this one, to be quite frank, okay? And that stock is Activision Blizzard. He sold out of Activision Blizzard, right? So Activision, 0.35% of the portfolio established in Q4 2021 at prices between $57 and $81. Next quarter's stake got increased by 340% between 63 and 82. There was a 1/3 reduction over the last 3 quarters. That was followed by a 70% reduction this quarter. Stock currently trades at 91. This was just an easy, buy. Just an easy buy for Buffett. Kind of almost more of a trade again there, right? In regards to kind of Activision Blizzard, the Microsoft deal and all that definitely helped their prospects out, and a huge arbitrage play here. And at the end of the day, if everything goes through there, it makes sense to just cash and move on and move that money somewhere else. So good work, okay. GM, so GM is 0.24%. 13F portfolio position. It was first purchased in 2012 at prices between $21 and $30, which just shows you that GM literally hasn't done anything in 10 plus years. Like, that's insane to think he was buying the stock between $21 and $30, right? Back over a decade ago. By Q3 2017, the position size had increased by around 6 times. Q4 2017 saw a reduction, and he's been, boom, 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 all over the place, right? The stock currently trades at $31, or the cost basis, on GM is $31. The stock trades at 34, so not much above, right? So this has kind of been a huge dog stock for Buffett over time, just to be quite frank. I mean, GM has been stagnant. Now, the one thing I'll say about GM, I don't own GM stock, but, I gotta stick up for it a little bit. It trades so dang cheap. Forward P on the stock's in the 4 range. If cruise automation ever is a big thing for them, that's not even priced in the stock whatsoever, obviously, right? The issue with GM is they're obviously having to shift their business toward electric vehicles, which is a whole shift you have to go through. That's not easy. And then simultaneously, they're having to shift their business to obviously the future, which is going to be humans not driving the cars, the car driving the car, right? And so that's a whole process to go through, and that was behind the whole cruise automation purchase years ago and things like that. So it's a tough battle. I don't think GM is a bad buy. It's certainly, once again, not my cup of tea, but I don't think it's a bad buy. The risk reward's pretty somewhat interesting because the stock trades so cheap. Now, on the flip side, interest rates are super high right now. They're going to probably remain high here for a bit of time. That's not good for the obviously the auto sector. And then if the Fed starts lowering rates, it's likely because we're going into recession, and recession's not good for automakers either. So that's the problem with GM is, although it trades really dang cheap, it's in a really, really tough position on several different fronts, right? You got going to electric vehicles, you got cars driving cars instead of humans driving cars, you got interest rate environment, you got the potential of recession. All that stuff is not good for GM, right?